So first and foremost, thanks everyone for joining us on today's webinar, Best Practice E-commerce P&L and Balance Sheet for Scaling Brands. My name is Jeff, and I'm the head of marketing here at E2X, and I'll be your co-host for today's webinar. But you'll likely be hearing less from me and more from Jason, who is our expert guest coming from Summit Ecommerce Advisors, who supports e-commerce businesses day in and day out with their accounting, their balance sheets, P&Ls, and cash flow statements. So it has a lot of incredible knowledge and insights to share in today's webinar. Hopefully you'll derive value from. So Jason, before we get started, I think it would be great for you to provide a little bit of context on your background and on Summit Ecommerce Business Advisors, and what the audience can expect from you today.
Sure, yeah. So a quick introduction first about us at Summit. We're a bookkeeping profit first coaching firm, big into profit first, and we're serving e-commerce business owners specifically. Why we're in business? We're here to support our clients, which is our e-commerce business owner entrepreneurs, with giving them actionable advice and reports so they can run their businesses. And then, our vision is to help as many e-com business owners as possible demystify the finance process so they can focus on building their businesses.
Awesome, great. So let's talk a little bit about today's agenda and the content that we're going to dive into. First and foremost, we're going to jump into P&L and balance sheet, some of the common mistakes and best practices. So if you're doing your own accounting today, if you're a seller doing your own accounting, hopefully we can provide you with some insights on some potential areas and pitfalls to avoid, and then some best practices to address those pitfalls. And then we're going to jump into the actual financial statements, profit and loss for e-commerce, what makes it different than a traditional brick and mortar retailer, how to purpose build a P&L for your online store, and then how to derive the insights required to help you run a successful business. And then we're going to do the same exact thing on the balance sheet side. I mentioned cash flow earlier in jest, but that's also another incredibly important financial statement. We're not going to be jumping into that during today's webinar, although it does have its place. So given the fact that we have a lot of content to a lot of content to dive into, let's jump right in. So first and foremost, P&L statement for e-commerce. Let's dive into the common mistakes on the P&L that you see from some of the businesses that are coming to your practice, Jason, who are coming from actually doing the work themselves.
Right. Yeah. And these are the four big ones that we see quite often. And it even comes from the professional in the accounting world as well, who don't have a background in e-commerce because the tech stack is so unique and things. So these are the top four, if you will, that we see regularly. Is the sales tax being included on the P&L, not on the balance sheet, the revenue, how it's being recorded, merchant fees, the platform channel fees like your Amazon, things like that. Shipping income is also a big bugaboo because depending on how like Shopify or Amazon records that and sends it over, can be put in the wrong place. Monthly sales and channel data, and then the big bugaboo is the cost of goods sold, of how to account for that, where does it go, how do you keep track of it.
Awesome. And then on the flip side, best practices on the P&L.
Yeah, so our recommendation is using an activity-based costing model setup, which is assigning it to a line item on your P&L based on the action behind it, not just because it fits in a box for the tax code. And we'll talk more about that a little bit later. And then aligning your revenue and cost of goods accounts, especially for your major platforms. It's a good idea to have those in somewhat unified sync on your P&L, so you can quickly at a glance look over it, and we'll go with that as well.
Nice. Can I ask a third question?
Sure.
Given the fact that many of today's attendees are likely doing their own accounting, I would imagine that some are even doing cash accounting.
Mm-hmm.
From a best practice perspective, especially for e-commerce, do you have a recommendation in terms to accounting method? Like, should it be cash-based accounting? Should it be accrual? Something else?
Definitely accrual-based accounting for your traditional three financial statements. Also, many of the functions inside of Xero and QuickBooks rely on the accrual method to record. So, data coming from the different platforms and through A2X, in fact, uses the accrual methodology inside of QuickBooks and Xero. So the payables, receivables, it's using that function inside of there. So you definitely want to be using the accrual reporting method on your statements.
Okay, awesome. And then shameless plug, A2X has a lot of content on the best accounting method for e-commerce. So if you are doing cash accounting and you want to transition to accrual to take advantage of a lot of the insights that Jason's going to be providing throughout the rest of the webinar, you can access that on the A2X blog. That was a smooth plug, right, Jason?
Nice slide into it,
yeah. Okay, so next up, we're going to talk about balance sheet for e-commerce, some of the common mistakes, as well as best practices.
Yeah, so no surprise probably to many e-commerce business owners, inventory is a big bugaboo again of how is it getting recorded? What do you do with items that haven't arrived to your location or your 3PL location? We'll dive into that a little bit more. Sales tax liability, again, if it's not on the P&L, it should be on the balance sheet and things. If it's not there, we know we have an issue we have to deal with. And then our payments in transit, the clearing accounts and PayPal, we'll dive into that a little bit more. This is actually the biggest issue in the last couple of years of getting how do we reconcile those, because many of those platforms aren't set up to share information in a way that's usable by us in our work.
Awesome. And it's a really great segue into the best practices. And then right after this, we're going to talk a little bit about the challenges associated with e-commerce accounting. You mentioned clearing accounts, which like that to me screams challenge, but putting the cart before the horse. Let's talk about some best practices for balance sheet.
Yeah. So our strong recommendation, unless there's a high operational need for your business, is do not connect your inventory platform to your general ledger, which is Xero, QuickBooks, etc. And we'll go into that of why we recommend that. Inventory purchases is an inventory in transit. We'll dive into a little bit more of that as well, of where to track those depending on your business type and how it affects your planning for cash flow and things. And then, yeah, we talked about clearing accounts, use software solutions, and we require this for all of our clients that are on a supported platform by A2X that they engage with that, so we don't have to do a bunch of manual work. Plus, it usually saves them several $100s a month in accounting fees if they wanted to do it manually.
And one of the cool things too, you mentioned it in your first bullet, don't connect an IMS to your general ledger. A lot of the IMSs available today allow you to turn off sales sync to your general ledger, so you can use a tool like A2X in parallel. So it's not as scary as it sounds. And then, I mentioned this just 2 seconds ago, but we're talking about the P&L, we're talking about the balance sheet, we're talking about some of the common mistakes and best practices, and it does feel kind of complicated. Do you mind providing some insight into like why is this just more challenging than a traditional business?
Yep. That first one there it's too much data. There's just way too much data available in the e-commerce world compared to other industries and niches. Because it's online, we have access to lots of potential data. And so more for e-commerce business owners, it's about what do I need to be paying attention to and what do I need to filter out. Again, another plug, I guess A2X here is it allows us to consolidate, daily sales into a single entry, which roughly in most cases matches the cash deposits when that's reconciled. So this is a way to manage that overflow or that overwhelming data that can come with e-commerce businesses. And then that segues greatly into the tech stack part of it. It's on ever changing. It's literally a quarterly update. I have a accounting mastermind for e-commerce accountants, and we're talking pretty much every quarter about the different IMSs that are out there, who got merged with who's not supporting who. And that's why an e-commerce specific accountant is going to be your best practice or best choice for getting clarity on your finances, because if you do it incorrectly, like clearing accounts, you're going to mislead yourself on what's cash is available and things.
And I would even argue that the sales channels themselves change quite a bit, and the data that comes from them changes relatively frequently. So if you don't have a really good pulse on it, especially from an accounting perspective, as you're really focused on running your business, on the marketing side, on acquiring inventory, you're not necessarily focused on the accounting side, it's hard to keep up with the data changes as they relate to accounting, and that's why it's actually quite beneficial to work with somebody who is really purpose built for e-commerce, like Jason, because they know that this is happening in the background and they can adjust and build it into their accounting process.
Right, and I'd add to that, Amazon by itself, there has to be several times a quarter where there's some change in a code from Amazon in the data dump. I'm sure you guys see it a lot over there at A2X, and we're figuring out, hey, where does it go in relation to what our client wants to see, and trying to match that up. And so somebody doesn't have that visibility, they're going to lose sight of things if it's not aligned to your general ledger and your chart of accounts.
100%. And speaking of tech stack, since we're on this slide, we did get a question from Giacomo, which is, do you confirm A2X works only for cash-based accounting? It's actually the opposite. A2X, and Jason, you can kind of jump in here, but A2X is really critical to providing you with accrual-based accounting for your e-commerce business. Anything that you'd like to add there?
Yeah, that's correct. It's the accrual function that in those general ledger programs, that is what we're using in A2X. And if we want to get super duper technical, it's actually a modified accrual or a modified cash basis accounting system. It's never fully accrual, it's never fully cash in any of the technology accounting solutions these days. And so, but what you do need to be checking is make sure your reports are the accrual basis in your QuickBooks or Xero or whatever platform you're using.
Yeah. I'd imagine if you're not doing accrual, then the balance sheet ends up being relatively worthless. But we'll get into that in a little bit. Cool. All right. So now into the nitty gritty, how to build a profit and loss statement for e-commerce. So Jason, this is where I'm going to pass the mic over to you, and let me know when you'd like me to move on to the next slide.
Sure. So I'm going to start with our income or P&L. So there's different terms out there. You'll hear income statement, profit and loss. Those are used interchangeably, at least here in the US. It's quite common you hear one or the other, but they're the same thing for our purposes here. And so this is built out in Xero. This is an activity-based costing P&L that we've built out. It's around different groups of activities. So you have our income, our direct costs. For us, that's cost of goods, and I'll dive into that a little bit. Sales and marketing, website technology, general administrative, and these are the groups of activities that we see for pretty much any of our e-commerce clientele. And then we will add different groups as we identify need with the client. And this one's primarily built around Shopify. You'll see the sales discounts, sales returns, and shipping income. This is exactly what Shopify sends over. And so we want to align that because most of our clients are going to their backend and looking and doing comparisons and looking at saying, did everything get recorded correctly? A big one here is direct costs. And you might say, well, why is it cost of good? Direct cost, we wanted to change the language a little bit because there's so much misunderstanding of what cost of goods is. For us, our interpretation, direct cost is every expense and item that goes into delivering the product to your customer. So if your customer doesn't have the product, it's not a fully affected sale. You can record it on your books using accrual as a sale, but if you don't deliver it, you'll have to refund them the money. And so what's all of the expenses that are part of getting that product to the customer? We want to track those here. And so the typical ones for us, obviously the product cost of goods. Again, we use a little bit simplified here just for ease of understanding. It can be a lot more detailed depending on our client's needs. The outbound shipping, that's part of it. And we put the merchant account fees here as well because it's easier for us to track, and it's kind of also part of the sale. And so there could be differing opinions depending on which account you talk to, but we leave it in the direct cost area. Some other items that would be here, your 3PL costs, warehouse, if you have warehouse staff, those would all be part of the direct costs as well. Because if you don't have a product to sell, you don't have a sale. And so those for us are direct costs. Excuse me. Next part is our sales and marketing, breaking it down by advertising spend. And so we take the different marketing channels, advertising channels, and put them in here by line item because many of our clients are tracking that individually. What's their total spend on Facebook? What's their total spend on Google AdWords? And then we have an aggregate advertising spend, because ROAS is still a big part of many of our clients tracking KPIs, and so we want this to be easy for them to track. You'll notice that we've got everything broken apart like this, and why we do these totals in betweens, because we know our clients are looking at some of these numbers. We want them to have quick, accessible visibility on these different numbers, so they don't have to come ask us every time, hey, what's my total spend? It's all right there. So if you design your P&L in a correct way, if you will, in our opinion, it makes it easier for you to work and understand what's going on in your business if you construct it from the ground up correctly.
100%. And I imagine, like, if your agency and consulting costs are going up, but your ROAS, well, effectively your advertising efficiency is staying the same, your growth is staying the same, then you could really pinpoint that and then try to resolve it. Yep. Hey, actually, before we move on, we did get one question that I'd love for you to address as it relates to COGS. What about the refunded COG in case I'm able to sell some of the product again? Where would I see that on the P&L?
Sell the product in, as in that they took the
product. Like it's like a return, I would imagine, that they could then sell again.
Yeah, so we would technically, how it would work is that the COGS would be deducted, and then the income would also be deducted. So we'd be back in inventory on the balance sheet. That's how it should be. Now, does it happen that way? Usually not. So this is on the income side, you see the sales returns. The other thing I wanted to say about that is that on the Shopify side, that's for any order that you edit after the fact will be showing up here in the sales returns. So like if you get a sale and you don't want to accept it, it's going to show as income, and then you show up on the sales return. That's a common question we get all the time. Hey, why is my returns? I didn't get that many returns. This is what understanding your technology stack and be able to explain that to clients, or in your case, if you're doing it yourself, understanding what's actually in that number and things.
You know what's crazy too is, so one of the things that we see a lot at A2X when somebody is new to A2X and they're not necessarily utilizing any technology, they tend to, not tend to, it happens a lot where a Shopify payout is coded as sales and the individual transaction that made out that payout aren't actually broken out. And that's kind of, here the P&L, you're looking at it right now, right? You can see clear as day that there's a ton of value in having that information broken out so that you can actually understand how the business is performing. So when you talk about tech stack, like that's effectively some of the value that you're referring to. Like this, it's this idea of getting kind of like a drill down into what the numbers actually look like for your store's performance, very clean and clear P&L. I didn't mean to jump in, but I just thought it was like a really interesting segue.
Yep. And as part of that, we're talking about the sales and marketing. As part of that, yes, you have your ad spend, but what about the other inputs that make that happen? So if you have an agency or if you have other marketing software, or other things like that, we want to put that in the sales and marketing bucket, because you need to understand as a business, or at least I would, if I own a business, what's my total spend around attracting customers to my website to buy from me. And it's this, some KPIs can mislead you if you don't understand all of the inputs that go into it. And so one, like on the ROAS, that's great, what your ad spend is, but if you have an agency managing that, I would argue that needs to be a part of that ROAS, because it's part of delivering, getting those customers to your website and things.
Cool. I'll let you keep going. I'll stop interrupting.
Yep. Quick, did we answer that gentleman's or that the person's question about the COGS and inventory?
Yeah, that sounded great to me. They have another question, but I'm going to wait until the end, which is unrelated. Yeah.
Okay. And then the next part is website technology. I definitely would want to have visibility on this, especially if you're often updating it and you have somebody supporting it. That would all be part of this. Of you need a storefront, if you will, and if you have somebody maintaining it part-time, we would want to put their salaries and stuff in here as well to break that apart. Then the general administrative things that can't be categorized directly to any of these groups, we would track here in general and administrative. You'll see in here, and this could be a term that people might misunderstand, discretionary income and earnings. And we don't have it on here because we didn't have the space to do it, but below that, we'll have an owner's compensation bucket. So owners paying themselves a salary, distributions, there's many tax advent actions that they could take that reduce their tax liability, but aren't inherent to running the business. We put that below that discretionary number because we want our clients to see what's the activities of the business generating revenue wise or net income wise. And then your operating income and earnings for tax purposes is down there. And then down below that. And then the last group is other income. And we see this a lot because we have a big group of drop shippers in our client roster of credit card points. Where do those go? And the last I've seen is that's not taxable income. And so we do not want to incorporate that into our sales numbers because that's not why you're running the business. You're running the business as an e-commerce business, not just to get points. So other income is any incidental income that's not related to the general operations of the business. And there's other expenses would fit in that category as well. So credit card points is usually the one we see the most of is those items there. And then every once in a while, we'll have a client who does consulting on the side for maybe other e-commerce businesses, other income. That's where we'll put that as well because it's not inherent to the business operations.
Awesome. I have two questions. One, I feel like you've touched on it a little bit when you were talking about the breakdown in sales and marketing and website and technology as it relates to headcount required to support. But the specific question is, do you split the staff cost among the different categories in the P&L?
Yes, we do. Like I said, we don't have enough space in here for the slide, but yes, we'll see like if you have contractors, employees, we won't have like a single payroll number. The one thing you don't see on here is a number for payroll. And that's because it's going to be split between the different functions of the business. And anything that's not assigned to those two groups there, then it's going to go into the general administrative part of it.
Awesome. Then another question before we go on to the next slide. What would be the rationale behind not including merchant account fees and the gross profit calculation? I agree it should be part of gross profit because it is a direct cost of selling product.
Yeah, and the other side of it is that it's not part of the value of the product. And I forget the part of the IRS code, at least here in the States, of what a cost of good is. That's why we line item it out on here. We're not going to have one aggregate numbers in case there's a difference of opinion with their tax advisor. We've got it lined up so they can put it in the right category on the tax return.
Awesome. Okay, great. So important numbers to note. So here are the call outs on the P&L that you wanted to refer to.
Yep. And so we put this slide together of it's not enough just to generate the income statement. Is how do we look at it? How do we understand what's the story that it's telling us about the business? And we like using either trailing 3 months, trailing 12 months, or year-to-year comparisons and using percentages to tell us a story of what's going on in the business. And I highlight a couple of these items here. We talked a little bit about the sales discounts, how that can be misleading. For us to be able to reconcile when we get a dump of data from Amazon, from Shopify, there's places where sales discounts that if you list the price on your store as let's say $100, but you effectively sell it for $95, that $5 has to go somewhere on your P&L, and so it gets put into that sales discounts bucket. And if you're running a program of some type of marketing campaign that's inherent, I would argue that you want to break that out and see how that's going. Now, I don't mean break it apart on your profit and loss, but you want to have a detailed picture for that campaign if it's really working. I'll talk to our clients when we have consulting calls, and I'll ask them questions about how this campaign works, how are you measuring it? And many times it's kind of from the hip. They're thinking that it's doing something, but they never really tracked it and things. And so this is one way for us to see aggregately where the sales discounts are coming from. Next to the shipping income, and how we determine this on the income side, the reason we break it apart is depending on your platform and how you list the item on your platform, shipping income, we would want to separate that out from aggregate sales things. And so separating that, Shopify makes that easy for us, at least on the Shopify side. Some of the other platforms, it's not as discernible, but we like to separate that out as much as possible because we have the outbound shipping that we want to measure that against as well. An example is we had a client that is a big ticket dropshipper, I believe it was, and he had items that were selling like $10,000 to $20,000, and so there's a flatbed shipping involved in this, and he was really like breaking even on several of his sales, and so we did some analysis with him and decided that he needed to start charging a shipping fee on top of in certain zip codes, because I think his supplier was in Kentucky or on the East Coast. And so his shipper was charging him more, obviously because of the West Coast deliveries. And so I think it was a $50 or $100 surcharge he started adding to that. So he was able to recapture some of his margin back on the shipping side by doing that. And having that big picture visibility allowed us to go in and dive into what's going on there.
Super smart. Yeah. And like it always sounds fluffy when we say like, oh, increase your financial visibility. You know, at face value, that in and of itself doesn't sound very valuable. But when you actually drill down and then you can actually derive insights and then provide recommendations like the one that you just referred to,
right.
This is where this kind of level of analysis becomes critically important. And then you also need the accurate data to be able to trust the numbers so that you are making the right recommendations.
Right. And you'll see like here in the product COGS, so you see the story from 2021, 22, and 23. In the product COGS, and you see the percentages there, 57, almost 58% one year. Oh, drop down to 49, and then goes up to 56. I'm going to ask my client, what's going on here? What did you guys do in 2022 that was different? And usually it comes out then we're able to get the client to, hey, what were you doing there? Why can't we repeat that? Is there something that's getting in the way? What was the story there? And so looking for those anomalies by looking at these comparisons is really what we're trying to develop that thinking. It's we prepare the numbers, now we need to work with them, or the business owner needs to look at these to better understand what's the story that it's telling us.
Yeah, it's not just about compliance, I think, as you're going through the numbers, even for me, that keeps coming out, which is fantastic. And then I didn't mean to interrupt, but you were going to go into direct costs next.
And so this is a place where we're going to put those costs that I was talking to earlier of direct costs. So any cost or expense outflow of cash that's related to delivering the product to the customer, we would want to include here. So if you have let's say a software that's related to your warehouse that interacts with your warehouse and your shipping carrier like UPS or something like that, we would want to put this here as well. So all those direct costs, because my experience is, and as a first consultant, almost always the issue is gross margin. That's the 80% of our clients, it's a gross margin issue. And so we're looking to push as many of those costs up into the direct costs so that our clients have that visibility. Because whenever I hear the term, hey, I'm trying to cut back on OpEx and I'm just not getting enough profit, it's almost always a gross margin issue.
Okay, great. So I'm going to move on to the next slide.
Yep, I was just going to say that. There we go. So again, next part here is we're still looking at the P&L with those different buckets that we looked at earlier. We were able to break out the owner's compensation part here as well on here. But again, we're looking at that story. What's it telling us? And like we talked about earlier, the freelancer sales and marketing. This is for most of our clients usually don't have a full-time marketing person on staff. They've got like one who's doing SEO, one who's doing paid ads. It's typically broken apart either as a freelancer or as an agency. Either way, it's going to go into this bucket here. Thanks. And again, one of the other things I want to mention was the Google AdWords. You see 6.7. 6.47, 7.6, and then it jumps to 10. I want to ask the question of the client, the business owner, what's going on here? Why is it going? And a story I have is, I think it was 2021 at July or so. We noticed across all of our clients that were doing Google Ads, a quick deprecation in almost everybody's return on ad spend, meaning like the clicks they were getting, a whole bunch of metrics just dropped compared to their ad spend. And we had I was having a client call, and the business owner was complaining. He's like, man, my Google Ads just tanked. And so I was able to tell him, hey, that happened to all of our clients, and he was, his words to me, I think, were, man, I wish you'd have told me that 2 weeks ago. It would have saved me several hours to sleep and things. So another plug for working with an e-commerce focused business accounting firm. You're going to hopefully get some of that visibility from them, because they're going to be able to see those types of things and stuff. And so, again, looking at these in comparison, not just preparing it for tax purposes, compliance purposes, but looking at this in a comparison way. That's why we do the work we do, is to give foundation to those stories that we can see what's going on.
Yeah, I feel like people use like Twitter and LinkedIn to hopefully get some level of benchmarking with their peers, but I actually, like, for me personally, I would trust the benchmarking coming from my accountant, because they see the numbers, they don't see the fluff. So I think that's a great call out.
Yep.
And then lastly, it looks like discretionary income and earnings.
Yeah, and this was, again, I kind of highlighted a little bit earlier of how we define that. This is the earnings of the business prior to any owner's compensation decisions that are made. We want to break that apart. Because we often get questions, again, for valuation purposes. Hey, I'm thinking about exiting in a year, and I want to keep track of my numbers. And this is how we allow them to do that regularly without getting those calls all the time. So that breaking it apart, giving them visibility, allows us to focus on our work. And yes, we want to work with them, but when we've gotten 2 or 3 calls a month from our clients, is like, hey, I'm trying to figure out a valuation. We already built it into their P&L, so they can do that work on their own and work with other advisors as needed.
That's awesome. Okay, so we did on the P&L side. Let's start talking about how to build a balance sheet specifically for e-commerce. So Jason, back to you.
Yep. And the balance sheet is quite often misunderstood and doesn't get the focus that it should from an e-commerce business owner. And maybe because it's not understood what's going on there, how do I understand everything? This is a simplified version of one that we'll kind of go over, and then we'll dive into a little bit more details in the next slides. The ones I want to highlight, let's talk about first is...
Hey, Jason, before you even highlight, you had mentioned something when you and I were chatting before we actually started doing the live webinar about the importance of a balance sheet, because most people who are doing their own accounting are kind of laser focused on the P&L and have kind of a, somewhat of a view of the balance sheet, but to your point, might totally be misunderstood. You had said something about it showing you the history. Do you mind actually providing the statement?
Yeah, so the balance sheet is accumulation of all the transactions on the general ledger for how many ever years the business books have been in existence. And it tells the story of, I can, my years of experience, I can just go through it and I can see how many different people have probably done the books because of all the different practices. It's all going to show up in the balance sheet if I look through it on a detailed way. So it's the story of the historical. The P&L is a snapshot of a single period of time. The balance sheet includes all of those times, how many ever years the business has been in existence. And so
it's like the balance sheet's more important when you're looking to acquire loans, potentially go through M&A, investments, so on and so forth.
Yep. And I can tell when we're onboarding a client, the first thing I go look at is the balance sheet, because that tells me usually how much work it's going to be involved for us to get them up to our standards and things. That's if a client's asking me on a call real quickly, what do you think it's going to be? I can usually have a pretty good idea just based on the balance sheet by looking at it. Yeah. So
awesome.
So for our assets on a balance sheet, the typical cash and cash equivalents. Now you'll see here other payments clearing and pending payments. This is unique to e-commerce businesses. This is where as we've talked about clearing accounts before. So for those in the e-commerce world, firms, your other payment processors where buy now, pay later are going to show up here. And this is important because this is often misunderstood or not even tracked for somebody who doesn't have that e-commerce experience. And you have to know where to go to find it. And so like in a firm, you're going to record the sale on your books using accrual. Well, you have to account for how much cash or cash you didn't receive. It's not technically a receivable because a sales kind of occurred, but the product hasn't been delivered. It's kind of this gray area. And so how we've accounted for it, and I think many of our peers in the e-commerce accounting world have done something similar, is created what we call clearing accounts. It's a other current asset and so we put it here. It's not available to the business owner. We don't call it a cash equivalent because the business owner does not have access to move those funds somewhere else. It's still not available to them to spend. And so that's how we account for it. And then pending payments, similar to like our PayPal, where it could be a couple days before the payment shows up into their account. We'll post that here. So those are two big e-commerce. I'm sure we're going to go into that a little bit more as we highlight things. And then typical liabilities for e-commerce businesses is the credit cards. Many of our, again, we got a big roster of dropship clients. They finance their inventory purchases through credit cards. Other ones would be factoring or inventory financing would go here. And then the typical on the equity side. So we can jump to the next slide. All right, so as I was talking about earlier, inventory and how that's kept track of. And we have two different categories here. The one I highlighted here is inventory in transit. Now this is there's other more detailed ways you could track this, but for us, what we do here is for our clients that are sending money to their supplier in advance of receiving the inventory, we'll at least going to track it here. In some to more detail, depending on what the client needs as we work with them. But at least we have a catch-all for those payments. So if they have a supplier, let's say in China or some other place overseas, you're typically looking at a 30% deposit. In most cases, before they even start the order, we need to account for that. And so we put that as an inventory in transit. If the client has a higher turnover or more money's going through those accounts, we'll probably break that down more for them if we have that visibility or access to that information regularly. Next is the pending payments. I kind of went a little bit into that as well. Again, we had a situation with a client that they had onboarded during the year. The previous accountant didn't have knowledge of how the e-commerce world works. And so there was a $25,000 gap on the cash side of it at the end of the year because this particular business had a lot of holiday sales at the end of December. And so they recorded the sales and there's a $25,000 gap between that because they never looked into what was going on there. And so we uncovered that because we onboarded them. We knew it was in those other pending payment accounts like the affirms and things. And so that's a microcosm of things that we run into for accounts that don't understand how the e-commerce flow of information works. And then next would be accounts payable, which I think that's self-explanatory. The sales tax liability. This is where we were talking about earlier of oftentimes the income number will have inclusive of the funds received, which should be for sales tax. And so if there's little or no sales tax liability, if they're on Shopify or any platform that's outside of Amazon, we're definitely going to look into what's going on there because this is a big, can be a big issue. It's I don't know, it's a very complex situation with sales tax in the US. Every state has their own rules. It can even get down to zip codes and counties. And you as a business owner, e-commerce business owner, at least want to have the funds set aside correctly. You don't want to get surprised with a notice. And so having that accounted for correctly will at least give you the visibility of how much cash you need to have for your sales tax payments. And do you have any questions on this part?
We do.
Okay.
So that's why I was going to pause you. So do you find that most of your clients are LLCs or S corporations? Are they many times drawing a salary during the year or just making distributions draws during the year? We see both. It just depends on what their tax advisor has given them. And we see
most of our clients are set up as LLCs and or taxed as a S corp. So again, in the US, there's some complications. LLCs are an legal entity. Your tax designation can shift how things are accounted for, but we see it both ways.
Awesome. Cool. All right. So on to the next one. How to get insights from your P&L. I feel like you've been pretty much talking about this throughout, which has been fantastic. But we're going to dive into this a little bit deeper.
Yep.
So I'm going to pass the mic over to you again.
Yeah. So like we were talking about earlier, preparing the information, that's our work. It's what are you gaining from it? And I'd say, unfortunately, many people in the entrepreneurial business world look at accounting as a cost, as something they have to pay for compliance-wise. And my argument has been, since I've been in this business industry, is we have to do the compliance side of it, but what can we gain from it? What value can we gain as business owners from looking at this? And a little background on myself is I'm not just doing accounting. I've owned other businesses, entrepreneur myself outside of the accounting world. And I've taken that experience and tried to incorporate that into how we work with our clients. And this is an example of putting this together in a way that I, as a business owner, can see where I'm spending money in certain parts of my business and things. And similar thing here is looking at this now. I did try to bring up in Xero, but the function wasn't available. And by the way, this is on Xero here to do a comparison on the balance sheet. But it's something I remembered afterwards. We'd build that out in Excel or Google Sheets for our clients because that function is not based in there. But again, we're looking at the changes in the increase in liabilities and or decreases. I want to ask the clients questions, probing with them to understand not just, oh, numbers, what's the story that it's telling me and things. So that previous slides that shows those comparisons, there are many different ways to look at the data, but my suggestion would be look at something consistently. That's going to tell you the story of what's going on in your business and things. And so preparing it is the part that we do. Analyzing it is up to the business owner to want to engage with their professional. And if they're not able to do those things, you probably want to look for somebody who is able to give you some of those insights, because otherwise it's a compliance cost. There's not a lot of value there.
How often do you do the analysis with your clients? Like, what's their cadence like?
So we have different pricing tiers. So we base it on the service level, not the transactions specifically. It's part of the picture, but our pricing is based on the service level that they're looking for. And so it's either monthly or quarterly, or just or not just, but an email update. So we will do a Loom video. One of the bookkeepers or the manager will do a Loom video recording of just reviewing the financials for the client.
Awesome. Cool. All right. So additional tips. And I think before additional tips, I think what I really liked about this webinar is we talked about the order of operations. Like, first things first, you need to have accrual accounting. The second thing is you need to have the right tech stack so that you're actually breaking out all of the discrete transactions that are happening on your sales channels, whether Shopify or Amazon. We didn't necessarily go into chart of accounts, which we can do a whole follow-up on chart of accounts in a totally different session. But then we're talking about the P&L and the breakdown of that information and what it means and where you need to focus. And then we did the same thing on the balance sheet front, right? So accrual, integrations, breakdown of information, P&L, balance sheet. Before we close off the webinar and address any of the final questions, let's talk a little bit about some of the additional tips, and then hopefully giving our audience a few minutes for them to ask any other final questions to Jason before we hop off.
Sure. Yeah. Consistency of data is the key to this. It's the format and the reliability of the data is super important, because 2 years from now, you're not going to remember that you switched a way you were recording your sales versus your discounts. You're not going to remember that. And so the consistency of the data is super, super important. Of how
you mentioned that about balance sheet, right? Like, you can look at a balance sheet and know how many different accounting or bookkeeping practices were a part of running the numbers, right?
Yep. And I can see when either changes in methodology, but it's usually around personnel that are doing the books. Either it's a firm, somebody internally. We'll see where the client's tax advisor has gone in and made journal entries, and that's something we don't actually allow. So when we're working with a client, the tax advisor gives us the journal entries, we'll look them over, and then we'll advise the client, yes, we're going to make them for tax purposes, but we want to make sure it's not going to mess up, if you will, the advising work that we're doing with the client, because they typically can be a big number that skews the numbers at the end of the year and things. And so we want visibility on that. And so we typically don't allow the tax advisor to have access to the QuickBooks or Xero to be making those journal entries directly and things. So being consistent on the data, and this is a common one, is when it comes to inventory, we don't want to hear "I think," because that tells me that no planning analysis, or there's no confidence in the numbers of how they're coming up with those cost of goods and inventory and things. And so we really want to get into that. It's good to get detailed at the beginning, especially if you're working with a new accountant, bookkeeper, advisor. Get into the details at the beginning, get that stuff figured out at the beginning. You don't want to be 6, 9 months, 12 months down the road trying to sort those things out. Have a plan of attack how it's going to happen. And when you're working with your accountant, advisor, bookkeeper, it's typically a 4-month onboarding, 2 to 4 month onboarding process for them to get really familiar with it. If you've got really good books, and maybe you can shorten that up, but just expect it's going to be a couple months to get everything sorted out and on the same page.
I have a really good relevant question that was just asked as it relates to onboarding. When onboarding e-commerce clients, do you have to do a lot of bookkeeping cleanup work? If so, what are some of the issues? Why there were prior bookkeeping issues?
Yeah, so we do see a lot of it, and it comes from not recording sales correctly. The things we see quite often is every single sale ends up on the general ledger, which it can be a nightmare. We've actually started over with clients where we create a new file for them. If they're not in business maybe for a couple of years, we'll create a new QuickBooks or Xero and start over. It's actually easier for us to do it in bulk, especially working with you guys at HOX, to get that data in a format that we can use, because it's almost always around the sales function. We can fix the cost of goods and inventory because that's usually big bulk orders and things. And with our dropship clients, because we have the visibility on the sales, it's usually pretty easy for us on that side. So almost always the errors are on the sales side and the clearing accounts and how that's being accounted for. And yes, it's almost always we're having some onboarding catch-up work to do with the client. Yeah.
Great, thank you.
And then the last part I was going to say is, when making changes, do it at the end of a cycle, quarterly, monthly, annually. Make a note of it somewhere. I would keep a log of, if you don't have to be super detailed on this, but an example would be you change an IMS. I would want to note we changed IMS on January 2023 because how they sort that data can be different. And I'm sure you at HOX probably seen in the background of how these things get. The things we don't see as business owners, or even us as accountants on the technology side, but it can be a simple coding error that can cause a lot of issues. And that's why we don't recommend, or we strongly recommend, that our clients do not connect their IMS to the general ledger for 2 reasons. One, software issues. The second is input errors. So employees, I typed 2 extra zeros on there, or I put the decimal point in the wrong place. Well, that gets to your general ledger. It usually doesn't get caught until a few months later on the inventory side, depending on when you're doing counts and things. And so
I was just giggling too, because when you said note when somebody changed an IMS, I feel like because of the level of complexity related to IMS, most business owners know exactly to the day when they change their IMS, and that's one of the things that's burned into their memory in perpetuity.
Yeah, there's usually a lot of pain associated with the transition, but it's important to note it and when you do it, because there's other ones that are smaller that have just as much influence on your numbers.
Yeah,
and things. And so noting those in a journal or something like that somewhere, so that you can share that if you're changing an accounting professional, that they have that that would be ideal for us, because that drastically shortens us figuring it out on our own, and therefore saves on the client's billings and things.
100%. Awesome. Great tips. So that's it for today's webinar. Before we hop off, we'll just make mention that if you want to continue the conversation with Jason and the Summit team, we're going to send a follow-up email with the webinar recording as well as Jason's information. So you'll have access to these links, and then you can go ahead and book some time with Jason. Jason, anything that you wanted to add before we hopped off?
Just glad to be able to help be a resource for everybody, and thanks A2X for you guys at A2X for putting this together. Big help for us and our clients and working, and we're glad to be of service to everybody else.
Well, thank you so much for sharing your expertise. And then on the A2X side, if you want to give A2X a shot, you can try us for free at a2xaccounting.com. I will also provide some information there as well in the follow-up email. Thanks everyone so much for joining. Hope you have a wonderful day, and we'll talk to you soon. Bye.
Thanks everyone.